reminded these days, unfortunately, of a talk that Leo and Sam gave in 2016 at Congress in Ottawa, the FPE Rick Davidson Book Prize Lecture, which they were receiving for the making of global capitalism. In that talk, which was in a small room about half this size, totally, completely packed, they raised the question, before Trump was elected, of the possibility that it would be the far right rather than the far left that affected the unmaking of global capitalism. So having written the book on the making of global capitalism, they then raised the possibility of the unmaking of global capitalism. And they hypothesized the role that the far right might play in this rather than the left. This set of reflections was developed into their 2019 Register essay, published, of course, after Trump's election, called Trumping the Empire, a very important essay that remains worth reading, in which they suggested that it would be ironic if the independence of the Federal Reserve, quote, explicitly designed by states and capital working together to protect the making of global capitalism from the progressive tendencies of democratic pressures on elected governments, should now come to save global capitalism from the threat of the political right. In the end, of course, the Trump threat was contained. The independence of the Federal Reserve did withstand the effort to, quote unquote, deconstruct the administrative state, as was plainly on display when the Fed acted with all of the emergency powers granted it in 2008, and then some, to address the COVID-19 crisis. This was the result of a development within the structure of the liberal democratic state, in which authoritarian power was concentrated within key state decision-making bodies, which were insulated from democratic pressures, including from the president himself. And I'm going to try to outline in my comments today the nature of this structure of state power. And I'm going to try to trace how it emerged during the neoliberal period, but especially how it's been consolidated and changed since the 2008 period, which I believe represents something of a break with neoliberalism. To begin with, as has been made clear from everyone's comments today, any serious analysis of states in advanced capitalism today needs to begin from the work of Leo Panitch. He was the leading state theorist in the world up until the time of his death 2 years ago, and he did the most important work on understanding the dominant tendencies and trends in the evolution of capitalist state power internationally. As opposed to social democrats and even some Marxist theorizations, Panitch and Guindon demonstrated, moreover, that finance is not a harbinger of the decline of the American empire or the hollowing out of capitalism, industrial capitalism, but is in fact a structural foundation of US global power, which makes globalization possible. So unlike those many theorizations of the process of financialization, which see this as a process of capitalist decline or the hollowing out of industry, Panitch and Guindon emphasize and illustrate how the process of financialization is a condition of American global empire. This, in turn, they illustrate, contributed to the development of a more authoritarian state. So the process of American empire developing took place as individual regional capitalisms, individual national capitalisms were internally integrated and interpenetrated through the flows and circulation of capital internationally made possible by global financial integration. Rather than having discrete, isolated national capitalisms or regional capitalism, we have one global capitalism made possible through the global integration of finance. And as this process took place over the 20th century, the American state power developed in a way that became more authoritarian. And those two processes went together. Indeed, one of the most significant contributions of Panitch and Guindon's book, The Making of Global Capitalism, is its rich illustration of the close interconnection between the rise of finance, the process of globalization, and the formation of an authoritarian state, of a more authoritarian state within the structure of liberal democracy. So this process of the development of an authoritarian statism, as Poulantzas called it, within the structure of liberal democracy, involved the concentration of state power in key, often highly secretive state agencies within the state administration, and their insulation from representative democratic structures. This especially pertained to those, as Greg mentioned earlier in his comments, which organize and manage the internationalization of capital, especially the central bank, the trade policy apparatus, and other key components of the state economic apparatus. Indeed, this was officially acknowledged by neoliberal ideology with the slogan regulatory independence. This is regarded as a basic tenet of good governance, And of course, regulatory independence means nothing other than the ability for these agencies to operate in a way that is not to be interfered with by political processes and elections. Meanwhile, those institutions that were concerned primarily with the legitimation of capitalism, as Neve in her presentation mentioned earlier today, were hollowed out or rolled back. So the main function that representative democratic institutions, for example, play in capitalism is legitimating the social order. If the police came in here right now and dragged me out of here, maybe not everybody in this room, but conventionally speaking, that would be seen as a legitimate thing because we elect the government that is, after all, responsible for commanding the police. So the use of state power is legitimated through electoral institutions. This also pertains to the role of political parties. The role of political parties in being able to implement a political program has been constrained and circumscribed as power has been concentrated in central banks all across the advanced capitalist countries, and certainly in the United States as well. So the legitimation apparatus, the state structures concerned with legitimation have been rolled out or hollowed back, what Amy Bartholomew referred to earlier as the evacuation of democracy. This, of course, also generates the conditions for a legitimation crisis, which is precisely what we now find ourselves in. Free trade. So the first component that this took, the first kind of aspect of this process was the concentration of state power in the US Trade Representative's office through the process of free trade. This entailed the construction of a parallel state whereby capitalist class interests, the interests of particular fractions of capital, which would normally have to be expressed within parliamentary institutions so as to be reconciled and a political consensus developed within the ruling class through the parliamentary processes that we associate with normal liberal capitalist democracy, now had to be represented directly in the state administration. So they constructed a parallel advisory commission structure, a parallel state through the US Department of Commerce, one of the things that I outline in my book that came out this year that Justin mentioned. Through an extensive advisory system whereby the interests of particular fractions of capital could come to be expressed directly in the state administration, thereby obviating the need for congressional consensus building among those groups, at least as pertained to trade policy. Now, what this meant was that that didn't mean that big capital or the most important factions of capital stopped lobbying Congress, but it did mean that attention to Congress as the primary way to influence the state became a sign of weakness of a capitalist fraction rather than strength. The strongest capitalist fractions were able to find expression of their interests directly in the most important administrative bodies. Of course, they still lobby Congress as well to limit the damage and the costs that are going to be caused by any potential policy changes. But the fractions of capital most concerned with Congress became those which were weaker. So this served. It went way back, really, back to the 1940s, but it was accelerated, especially with the 1970s, with the development of the trade advisory structure that I just mentioned to you in the Department of Commerce, which the U.S. Trade Representative sat on top of. It served to contain protectionist pressures, both in Congress and among business, especially among the smaller petty bourgeoisie fractions and smaller capitalists that couldn't restructure internationally and were raising protectionist challenges to globalization. Those forms of dissent and contradictions of globalization were marginalized and stifled through the development of the authoritarian state structure I just mentioned. Leo already recognized this in his groundbreaking essay on globalization of the state in the 1994 Register, in which he first set out the dominant thesis that would animate the making of global capitalism of Sam Gindin, in which he wrote, quote, globalization involves a shift in power relations within states that often means the centralization and concentration of state powers as the necessary condition of and accompaniment to global market discipline. So as you get greater free trade, you also have the centralization of state power in these highly secretive, highly authoritarian state agencies that invite the capitalist fractions they want to work with inside the administrative structure and leave other fractions of capital that might not be so favorable to such policies outside, allowing those interests to be reconciled and organized. This process of the development of a more authoritarian state was also driven by the key role played by the US state in crisis management. So it is impossible to overstate, and it's hard to even realize from our current, where we sit today, how significant was the concentration of power within the Federal Reserve that took place in 1979 with the unprecedented hike in interest rates through the Volcker shock. When Paul Volcker became the chair of the Federal Reserve and hiked interest rates to unprecedented highs, that also served to concentrate power radically within the Federal Reserve to such an extent that even capital would express concerns about the undemocratic implications of this, as the main lever of macroeconomic policy management was now in a completely undemocratic and relatively secretive and isolated institution, the central bank. Moreover, as barriers to capital mobility were reduced, the needs to manage the emerging and much more volatile form of financialized global capitalism that emerged after 1979 led the Federal Reserve and the Treasury to serve as global firefighters in chief, running around the world, putting out crises in countries around the entire planet, in a way, and requiring a form of rapid, internationally coordinated intervention that reinforced the insulation of these institutions from democratic institutions. Right? These highly secretive, highly concentrated state powers were cleaved off and insulated from representative institutions. That was reinforced by this process of serving as global firefighters in chief. This process of globalization, simultaneously as all this is happening, led to the close entanglement of the interests of financial and industrial capital. Very close entanglement between financial and industrial capital. And this was not just because non-financial corporations depended upon the integration of global finance for their own competitiveness and profitability coming out of the 1970s crisis. The way they resolved the profit squeeze that they were under in the 1970s crisis, the way that they restored profitability was by reducing labor, regulatory, taxation costs, resource costs, by globalizing. And so the infrastructure, the basic infrastructure that allowed that globalization to occur was the integration of finance. So on that level, the interests of manufacturing and financial capital became very closely intertwined. Manufacturing capital loved financialization and loved globalization because that was a solution for them to the 1970s crisis. Moreover, as the process of globalization after 1979 unfolds, the non-financial corporation itself, and this won't be a surprise to my students who just took the seminar on corporations, finance, and the state, the non-financial corporation itself was deeply financialized. Now, what I mean by this is not that non-financial corporations started becoming banks. What I mean is that as they diversified and as their operations internationalized, they were reorganized in such a way where top managers became effectively investors, circulating money capital across what they increasingly saw as a portfolio of independent business operations. They were almost like separate companies, separate capitals. So the top management now saw itself as an investor, circulating money capital, across a portfolio of financial assets, a competing portfolio of business operations, which were competing for investment based on their ability to generate profit. So you have within the firm the internalization of competitive capital markets. As this happens, the very difference between financial and non-financial corporations begins to become blurry. So finance and industry, what's a financial corporation and what's a non-financial corporation, becomes much harder to determine. Non-financial corporations themselves become systems of investment or financial groups. Now, as Panitch and Gindin emphasized, this was not a matter of the hollowing out of production or the decline of industry, but it was about intensifying competitive discipline to maximize profits, to offshore production, to increase competitiveness through the global mobility of capital, and the ability to flexibly restructure corporate operations and industrial capital. This amounts to the first component of what Scott Aquano and I, in our recent Socialist Register essay, refer to as the new finance capital. Now, it's important to pause for a minute and define what is meant by finance capital. In the Marxist sense, as laid out by Rudolf Hilferding, it does not mean the financial sector. It's always used wrongly, the term finance capital. Financial capital refers to the financial sector. Finance capital, as Rudolf Hilferding theorized it, refers to the fusion of financial and industrial capital, which is exactly what you see emerging with the neoliberalization and financialization of the non-financial corporation, a fusion of financial and industrial capital. That is finance capital. So that was the first component of the new finance capital. The second component emerged after 2008, with a fusion between the non-financial corporation itself, financialized though it was, and the financial sector. And this took place through the concentration and centralization of corporate ownership on a scale completely unprecedented in the history of capitalism in a new group of asset management companies, giant asset management companies. So especially the big three, BlackRock, State Street, and Vanguard. They amassed an unprecedented scale and scope of capitalist concentration. Nothing like it has ever existed before. As a result of that process, these institutions were able to displace the banks as the most important institutions within the contemporary financial system. So let's step back for a minute. 2008 was the third great crisis of capitalism and the biggest and deepest since the 1930s. Each of the great crises of capitalism led to a transition to a new phase of capitalist development through a restructuring of the institutions that constitute that regime of production, of accumulation, right? Because a crisis is a crisis of the institutional structure, that defines a particular phase of accumulation, that institutional system has to be restructured in order to move on to another phase, the next phase of capitalist development. 2008 was no different. The first was 1929, in which the classical regime of finance capital, theorized by Rudolf Hilferding, transitioned to a phase of managerial capitalism in which the industrial corporation was hegemonic. The second great crisis of capitalism was, of course, the crisis of the 1970s, which was resolved in 1979 with the Volcker shock and gave rise to a new form of financial hegemony, which we know of as neoliberalism, a relatively oligarchic and relatively diffuse form of financial hegemony. And finally, the last great crisis of capitalism, 2008, 2009, which led to the rise of a new form of finance capital, quite similar in many respects, although not identical, to that which Rudolf Hilferding theorized in his classic text by the same title. So in the wake of 2008, the Fed undertook a radical and unprecedented rescue of the entire global financial system with very minimal democratic legitimacy. The TARP bill that was so hard to get through Congress was simply a fig leaf of democratic legitimacy. It didn't amount to even a tiny fraction of the amount of money that the Fed put into the financial system. The TARP bill was $700 billion. The Federal Reserve pumped trillions of dollars of liquidity into the financial system and then disregarded the congressional parameters for the TARP bill by simply using that money to nationalize the banks, albeit without control. Just as an aside, it's worth mentioning here that the Federal Reserve learned its lesson from the difficulty of getting TARP through Congress and didn't even bother when it came to the COVID-19 rescue. They just acted, and they acted on a scale equivalent to what they did in 2008, with absolutely zero democratic legitimacy. However, in 2008, despite the difficulties of passing TARP, the insulation of the Federal Reserve from Congress did succeed in protecting it from nationalist blowback in the form of the Tea Party, even as those forces were able to gain power and capture new positions within the representative institutions of the capitalist state. They could make all kinds of demands, they could make all kinds of pronouncements, but the Federal Reserve was insulated from those pressures and was able to carry out the rescue of the global financial system. Now, the Fed's rescue of global finance had two phases. The first phase was a phase of stabilization. In this phase, it was characterized by the ad hoc deployment of state power to rescue, to manage the immediate fallout of the crisis. So the ad hoc deployment of state power to stabilize the financial system and manage the immediate fallout of the 2008 crisis. The second phase was a phase of consolidation, in which the supposedly emergency measures were made permanent, and the financial system became dependent on the continuation indefinitely of these emergency practices and functions. The normal functioning of the financial system, integral to that functioning, became these emergency measures. So consolidation was characterized by basically two different things. First of all, the Fed orchestrating the extreme concentration in the banking sector, merging investment and commercial banks and leaving only a handful of mega banks left after that restructuring. That was one part of it, which we're going to leave to the side for now. We can deal with it more in the Q&A if you want. It's very interesting in itself. But the second was the continuous extension of quantitative easing. Now, quantitative easing works as follows. The Federal Reserve transfers money to financial institutions and banks by purchasing treasury bonds and other securities, but especially treasury bonds from the banks. So the result of that is that the Federal Reserve now has on its balance sheet treasury bonds and mortgage-backed securities, and the banking system in exchange has lots of money. So that is the mechanism whereby quantitative easing extended mass liquidity to the banks. The Federal Reserve bought up treasury bonds and mortgage-backed securities and transferred that liquidity to the banking system. Now, the result of that, of course, banks like to make money, so they need to take the money that they now have and find other ways to make money with it. Because you're not going to make any money off of buying treasury bonds when the interest rates are basically zero or even negative in real terms. So what they do? Well, they purchase other riskier assets, especially equities, corporate stock, right, which had the result of inflating in a generalized way the asset values of other assets. So by bailing out mortgage-backed securities and by extending this liquidity to the banks or QE, the Federal Reserve actually created generalized asset inflation across the entire economy, de-risking not just the financial assets that they wanted to protect, but all other assets in the financial system. So as these investors' flood of money moved into corporate equities, as the Fed absorbed U.S. Treasury bonds, it made it very, very difficult for what we think of as the classic model of financial investment funds, actively managed investment funds, to justify the very high management fees that these funds charge to beat the market, right? So in an active fund, an actively managed investment fund, you pay a money manager a lot of money, millions of dollars, and that person says that they can beat the market and outperform the market as a whole. And you pay them for that. They make strategic trades and they are able to make you money. Theoretically, that outstrips the performance of the market in general. In a passively managed fund, the fund simply tracks the performance of a stock index like the NASDAQ or the S&P 500 so that the weight of its holdings in the portfolio reflects the weight of individual firms in the index, right? So as a particular firm ascends in an index and performs better, those funds will purchase those stocks. As a firm descends in those indexes and performs worse, those funds will sell those stocks, right? The idea is that the weight of a particular firm in an index fund reflects its weight in an index. So the result of the de-risking through quantitative easing was a historic flood of money into passive investment funds. And how historic am I talking about here? How big am I talking about here? Well, before 2008, 75% of equity funds were actively managed. By 2020, 50% were passive, with passive funds having $6 trillion in assets under management. Now, obviously, that meant the concentration of massive blocks of ownership power in the hands of the companies, the financial institutions that manage these passive funds, which are primarily the big three asset management companies, Vanguard, State Street, and especially BlackRock. Between 2004 and 2009, BlackRock's assets under management grew by an unbelievable 879%. This is a massive historic shift in the organization of capitalist power and an unprecedented level of concentration and centralization of corporate ownership. Now, you can also illustrate how significant this is by looking at which firms they primarily own. So this amounts to 90% of total U.S. market capitalization is in the hands of the big three. They're either the largest or second largest holders in firms that comprise 90% of the U.S. market capitalization. Now, when you look at the S&P 500 index, which is the index that indicates the most significant, the largest and most substantial corporations, the big three are the largest or second largest shareholders in 98% of the S&P 500, with an average of 20% holdings in each of those companies. That's often thought of as a controlling stake. So they have a controlling stake in 98% of the S&P 500 and in a total asset value equating to 90% of the total market capitalization across the economy. So what this means is that rather than owning one particular firm or one particular sector or one particular group of firms based on a particular market strategy, these companies own the market as a whole. And in so doing, by offering passive management funds, they are able to tremendously reduce the costs of diversification to individual investors. So these passive funds are often traded on stock markets. They are what's called exchange-traded funds. So if you want to invest in one of these passive funds, the way you do it is you make a stock trade. You buy a stock on the stock market, and then you have a share in this fund. So with one trade, you have a share in the entire market, not just in one particular company. So this facilitated this process of concentration and centralization. It allowed these companies to draw together the huge pools of money capital that had been assembled within the pension funds over the neoliberal period, and also to draw in high net wealth individuals and households by offering a way to invest in equity that was almost as accessible and nearly as safe, apparently, as a bank account, and almost certainly more profitable in a context in which interest rates are zero. What this amounted to then was a positive feedback loop in which the de-risking of equity through quantitative easing led to the increasing size and diversification of asset management companies, which in turn, as money flooded through those asset management companies into equity markets, led to the further de-risking of equity, the further asset price appreciation in equity, which then further encouraged the flood of more money into the asset management companies in a positive reinforcing loop in which the concentration, centralization, and diversification of these management funds, managed by these asset management companies, continued to grow. Now, as these companies gained a controlling stake in every major company in the economy, they played an increasingly active role in corporate management. And the reason for that is because this regime, despite the concentration and centralization that it represents, is highly competitive. So asset management companies compete with one another, and they also compete with every other outlet for savings. Hedge funds, private equity companies, right, bank accounts, any other place you can put your savings, they're competing with that possible option that you have as a saver. Now, what that means is that they need to be able to offer you a return that is competitive with those other outlets. So these companies have an incentive to maximize the returns that they're getting for their investors in their competition with other possible places that they can put their money. They have to offer the highest returns and the lowest risk. Now, as we saw, as I just mentioned, this competition imposes very strict limits on the fees that these companies can charge, hence the turn to passive management and the non-competitive nature of active management. What that means is that they also compete, since they can't increase their fees, to continually expand their assets under management. One of the main things they're competing over is to grow their assets under management as much as they can, because their fees are calculated as a percent of the assets that they manage. The more assets you own, the higher your fees. So one of the main outcomes of the competition between these companies is to continuously grow the assets under management. It also means that they have an incentive to increase the value of the assets they already manage and already own. Again, their fees are calculated as a percent of their assets under management, so they want to both grow extensively grow their assets under management and increase the value intensively of the assets that they already hold. Therefore, what this means is that in the context of passive management, in which these companies can't trade contractually other than to reflect the changes in the index that they're tracking, competition manifests itself as control. The only way they can influence these companies is not through trading stocks subjectively to discipline underperforming firms or firms that they're not happy with strategically. The only option they have to enact these competitive pressures is to directly connect with and pressure management. That's the structural outcome of the system. The way this is organized within these companies, and again, this resembles kind of closely Hilferding's model of finance capital from the 19th century, is that management of their portfolio companies is centralized within what they call stewardship divisions. Now, stewardship divisions supervise the implementation of governance reforms in corporations that they control. They influence board composition, who's on the board. They want more independent directors, oftentimes very activist hedge fund managers, et cetera. They approve executive compensation, oftentimes vote against it. I forget what the exact percentage is. It's in our article, but definitely not insignificant percentage of the time. And they supervise strategy. So these companies are not afraid to exert pressure. And the fact that they exercise very, very large blocks of voting power in shareholder meetings ensures that the management of companies that they invest in are going to pay attention to their interests and what they want done. So all this adds up to a very broad restructuring of corporate power since 2008, which has replaced the neoliberal model of shareholder capitalism, which was a more polyarchic and diffuse form of structural financial hegemony in which ephemeral coalitions of financial institutions exerted broad discipline over industrial corporations and indeed within industrial corporations. This is a very different system. It also served politically to entrench the class consensus within the ruling class around globalization and continuation of working class discipline, right? They depend on the companies that they hold, maximizing their profitability, maximizing the asset values, which means maximizing their individual competitiveness as individual companies, which therefore means globalization, capital mobility, et cetera. This is framing that I just laid out is very different than a quite prominent strand of analysis of this system, which refers to it as asset manager capitalism in many cases, which basically oftentimes sees the emergence of these asset management companies as constituting the basis for a new social democratic compromise, either through something like Bidenomics, where they can support expansionary fiscal and monetary policies, possibly even social spending, or ESG, environmental, social, and governance, green investing or impact investing. So there's a very influential strain of social democratic analysis, which holds basically that the concentration and centralization of ownership within these companies opens the possibility for those two social democratic compromises. Both of these arguments are grounded in the understanding that these asset management companies are so-called universal owners. And the theory goes that as universal owners, that is to say, they own every company in the economy, they have an interest in forcing the companies that they hold to internalize the costs that would normally be externalized onto the market. So in a normal market competitive system that these theories hold, individual corporations, individual firms have an interest in externalizing as many costs as they can, right? Creating externalities. That is to say, not paying for shit that they're breaking, right? Like when a company destroys the environment, it just allows the state or society as a whole to bear those costs. It doesn't want to bear those costs. So if selling SUVs results in climate change that's going to kill us all, well, the company that makes Hummers is going to fall for that, and they're not going to pay for it, right? So the logic of universal ownership, according to these social democratic theorists, holds that because these companies own the economy as a whole, they have an interest in forcing their portfolio firms to re-internalize these costs. And indeed, BlackRock has been a major proponent of ESG investment. Brian Deese, a former BlackRock executive, was Joe Biden's top economic advisor, the chair of the Council on Economic Affairs. And BlackRock has issued reports calling for fiscal and monetary expansion. However, if you actually look, ESG, which indeed BlackRock is a proponent of, has nothing at all to do with stopping climate change or helping the environment. As a matter of fact, it's about exactly the opposite. ESG does not measure the effect of a company's profit-making strategies on the environment or the ecosystem. It measures the impact of a collapsing ecosystem on corporate profits. That's what ESG measures. So what it's all about is about investors safeguarding the long-term competitiveness of their assets in the context of ecological collapse. So again, nothing at all, in most cases doesn't even account for carbon emissions as a part of those metrics. It's equally hard to see how the system that I just laid out could serve as the basis for a new class compromise, let alone one on the order of New Deal. So first of all, we have to mention that Joe Biden's support for social programs was highly limited, despite the way over the top comparisons to Franklin Roosevelt and everything that we saw earlier in his presidency. But his industrial policy, which has been more real, as we've seen with the semiconductors and so on, has everything to do with improving the competitiveness of U.S. multinational corporations. It has very little to do with this reversing the devastation of working class communities caused by 4 decades of neoliberal globalization. Insofar as such programs, as say the limited social democratic programs Biden supports, or just the fiscal expansion in general, that could lead potentially to tighter labor markets, therefore worker mobilization and higher wages, insofar as those programs lead to higher inflation, it undermines the whole system, because the whole strategy, because asset management companies are opposed to higher inflation. And indeed, once we saw inflation ticking up, Larry Fink got out even ahead of the Federal Reserve, the CEO of BlackRock, in insisting that the Federal Reserve raise rates. So they don't want high inflation. They want relatively low inflation. As a matter of fact, the higher that inflation gets, the less the gains they get from their asset values increase, right? They need their assets to increase in value more rapidly than generalized inflation across the economy in order to make money. So they're not in favor of anything that's going to cause inflation. So the whole support that they might exhibit for fiscal expansion, monetary policy, industrial strategy is completely dependent upon the continued docility of the working class, continued class discipline, and continued globalization. And as I've laid out, in terms of their relationship to individual firms that they hold as universal owners, they have an interest in maximizing the competitiveness at the firm level of each individual company, right? After all, even if they are universal owners, which they are, higher costs in one sector lead to higher costs in another sector, right? So they have an interest in maximizing competitiveness across the system, maintaining individual competitiveness of each individual firm. And indeed, as I've just said, Larry Fink supported rate increases when inflation ticked up, even ahead of the Federal Reserve. So this raises the question, how dependent is this system of new finance capital on continued QE and low interest rates? Because after all, now we're seeing interest rates increasing and quantitative tightening replacing quantitative easing. Can it survive in an environment of increasing interest rates and tapering? Now, of course, a market crash could be just as disastrous for the current finance capitalists as it was for those in 1929. And so that shouldn't be discounted. But passively managed funds, these big asset management companies, the only thing they're doing is not managing passive equity funds. They're also the leading shadow banks in the current financial system, meaning that they do cash management, they do lending, they engage extensively in repo trading. That is to say, making money by lending the securities that they hold, the vast stockpiles of securities that they hold to other investors on repo markets. So those activities will become relatively more profitable as interest rates rise. So because they're diversified, the extent to which they're vulnerable to volatility in equity markets is very much in question. And in fact, in the context of greater market volatility and rising rates, and a more difficult time capturing gains on equity markets, one would think that the super low fee model offered by asset management companies could become even more attractive to investors. So because of their diversification and because of their fee structure, it seems quite likely that the market power, the ownership power of these companies will not be diminished despite raising rates and greater volatility. Their position is also significantly bolstered by the Federal Reserve now having extended extensive new support for shadow banking since 2016, especially since 2008, but especially since 2016. So without getting into it in too much detail, we can get into it in the Q&A if you want to. At the center of the financial system right now, in terms of the credit system, are repo markets. Repo markets generate credit where one person temporarily buys an asset from another person, thereby, and with an agreement that they'll sell it back at some fixed point in the future, thereby generating credit, right? I give Susan money, Susan gives me her asset, she agrees that she's going to buy it back at some future time. I basically borrowed money from her with the collateral of the asset that I've taken. Now, this system obviously depends on assets with stable values. So if the asset Susan's giving me is fluctuating all over the place, obviously, I'm not going to be willing to make this repo transaction because I might lose my money. I need to be able to believe that I'm going to be able to get my money back with interest, i.e. basically a loan. She's giving me collateral, it's a loan. So since 2008, the Federal Reserve, and 2016 especially, because these assets were at the center of the crisis, especially mortgage-backed securities, what the Fed basically did through QE was extend massive support to backstop the value of mortgage-backed securities that were at the center of the 2008 crisis. So since that time, those functions of the Federal Reserve have been extended and consolidated so that now, much like the Federal Reserve does overnight lending to banks, they have overnight repo markets. They have overnight repo windows. So the Federal Reserve every single day is engaging in extensive repo transactions with financial institutions intended to set the price of the main collateral on repo markets. So all of these assets, the Fed is controlling their prices by agreeing to purchase them or agreeing to purchase them if they fall below a certain value and then selling them if they rise above a certain value. So the Fed is engaging now extensively every single day in repo transactions to stabilize this collateral. Now, who's the biggest asset owner? The big three asset management companies, right? So the development of this greater support for repo markets and therefore the credit system has resulted in a very, very close interconnection now between the big asset management companies and the Federal Reserve. BlackRock directly buys and sells with the Fed on repo markets every single day. Every single day, the Fed absorbs $150 billion in BlackRock cash and transfers BlackRock $5 billion in profits at current interest rates every day. So the idea that market volatility is going to be the death knell of the structure of new finance capital, I don't know. I think that there's good reason to doubt that. And the shadow banking, the systemic role of these institutions in shadow banking is one reason why. As this indicates, the flip side of the consolidation phase of post-crisis intervention is the statization of the financial system. The financial system has now become thoroughly statized to the extent that the Federal Reserve is the dominant institution in the private financial system by far, and has ensconced private financial markets and functions with state power in a way that has enhanced their durability and entrenched the major institutions which profit from and operate on private financial markets. So there is still the question, of course, that Panitch and Ginnin raised in Trumping the Empire in 2019 of the extent to which the Federal Reserve's independence and so on can withstand the threat of the far right. To what extent will the Fed be able to withstand the hard right continuing to build within representative democratic institutions? In the recent midterm elections, of course, Trump was dealt a very serious blow, but there's also other worrying signs elsewhere, including Poilievre in Canada. Now, big capital, as of now, seems quite unlikely to extend significant support to these hard right forces, thereby opening the possibility for a fascist government. However, the presence of these forces and the growth of these forces in representative democratic institutions has led capital to fully support redoubling the efforts to insulate the key centers of power within the state from the chaos and interference provoked within the representative democratic institutions and political party systems. So the insulation of power from democratic institutions has been redoubled and entrenched, as I just mentioned, by comparing the Federal Reserve's rescue after COVID-19 to the rescue that it undertook after 2008. This raises the question of how far can this go? How much crisis does the far right have to cause, or we actually have the possibility for some kind of emergency rule or the further closure of democratic space with the full support of big capital, even in the interest of constitutional rule and democratic legitimacy? It's hard to say right now, but I can say that the support that big capital extended unanimously for Trudeau's invocation of the Emergencies Act isn't exactly encouraging in order to shut down the hard right. There's been other cases too internationally of a kind of centrist authoritarianism in the interest of safeguarding constitutional rule. All this means that addressing the authoritarian structure of state power and the limits of liberal capitalist democracy cannot be put off into the distant future. These are questions that are very pressing now, not just for utopian reflections on future socialist society, but safeguarding the basic democratic freedoms and political openness that we think of as at the core of our current societies. As I've suggested, taking this on and winning substantial gains for workers points to the need to go beyond narrow critiques of financialization, as social democrats have often focused on, to challenging globalization itself and the authoritarian structure of state power that has enabled and supported it. It's simply the case, as I think I've shown, that there is no way to separate industrial capitalists who have been victimized by globalization and financialization from financiers who have benefited from it. There's no way to separate these things. It is time to move past the tried and tired strategies of building an alliance between workers and manufacturing capital to limit the influence of finance. It's not going to work. They don't have an interest in building that alliance, and we need to move on from that. Moreover, as I've shown, addressing the existential challenge of climate change requires moving beyond ESG investment strategies and finance-led initiatives to a Green New Deal, which of course raises the question of what form the Green New Deal should take. Is it going to involve undertaking contracts with private corporations that have the capacities necessary to retrofit our economies and decarbonize our economies? Or are we going to do this democratically, which means nationalizing parts of capital and taking those capacities which corporations currently own and control, which we need to turn to social and ecological needs under public democratic control? If the latter, they will resist. The capitalist class will resist. And one of the major sites of that resistance will be found in agencies like those which have been the site of the concentration of authoritarian state power over the neoliberal period, Treasury and the Federal Reserve. So we need to think through a strategy of green socialist transition, not as a utopian project, but as a pragmatic necessity now. In terms of what we're going to do with the Federal Reserve and the Treasury, we need to think through how we're going to fundamentally transform these agencies and build the state capacities to run finance as a public utility, as Leo, Panitch, and Sam Ginden called for throughout their entire careers. It's not enough to simply nationalize the asset management companies, which do not engage in anything like society-wide economic planning, but direct investment based on profit and price signals. Investors, including pensions, would not entrust their assets to a company that has been taken under control of the public and has moved away from competitiveness and profit maximization in order to meet social needs. Those companies depend on investors voluntarily, giving them money to manage. And they're not going to do that if those companies have been taken over by the state as a kind of socialist conversion fund. So you need to go beyond that. You need to look at the deep plumbing of the financial system and think through how that can be democratized and turned to social and ecological needs, to servicing social and ecological needs. Now, this may sound utopian, but given the situation that we're in, I would argue that the real utopians are not those who are striving to envision the radical changes necessary to ensure that we have a future worth living, but those who think we can keep things as they are and that radical change is not necessary. Thank you very much.
So we've got about 10 minutes for questions, and I'll take maybe 2 or 3 at a time. First, yes.
Is it like such a look that people experiment, but are there many people thinking about this 10 years ahead and knowing what's going to happen, or then a lot of mistakes along the way? I don't see anybody behind your story. I need to.
Some more? Yeah. Richard?
Can sort of a liberal idea of democracy and socialism coexist? If so, if not one.
One more? Professor Rosemary.
I'd like to hear more about the Canadian situation in terms of these exchange trade funds. Is that happening in Canada as well? And how does that loop work in Canada? I'm thinking of it when you raise Collier, he's criticizing the Bank of Canada, and so I'd just like to hear. Can you tell us a bit more about the Canadian situation?
Doesn't ask a small supplemental. Sure. I wanted to ask about how it was my sense that in some countries, not least Canada, but Germany, etc., that insulation of the treasury and those central agencies and central banks goes back a lot further than the state. So is there a somewhat different history in the state?
So in terms of the question about human beings and human consciousness, I would I would suggest that, or I recommend, or I don't know, I feel weird even saying that. If you're interested, I wrote a book called Corporate Capitalism and the Integral State, in which that's the main thesis. That actually the only way of understanding these processes, and that goes up to 1980, is to look at the way that state managers and corporate executives actually puzzle through these things historically. And actually, you know, I did it very quickly and I put a neat little bow on it. But in reality, for example, the 1970s crisis was not one in which the resolution was immediately obvious or forthcoming by either the capital or the state. It took, this is just one example, of course, but it took 10 years of fumbling around with wage and price controls, some state officials believing that wage and price controls were going to be a new normal within American and indeed advanced industrial societies in order to control wage growth and maintain profitability. In terms of the story I just told about asset management funds, it's hard to know where to focus in on answering your question, but one example would be, for example, ESG. So where does ESG come from? Well, it comes from two places. First of all, a desire on the part of these huge asset owners to protect the value of their investments. And they're just operating on market logic. And ESG funds have taken off because there's the connection between that ideational innovation and market competitiveness, where they can sell them and people want them. And then they grow and they become more popular. And, you know, so then it develops a life of its own. The second reason, of course, that ESG has become so prevalent is because of legitimation. So it makes these companies look like they're nice guys, and we don't need to do a big, expansive state strategy for nationalizing parts of the economy. This corporate social responsibility already happening. So, you know, I could give a longer and more kind of subjective orientation, explanation for a lot of these different dynamics, but I appreciate your question in that regard. In terms of the question of the compatibility between liberal democracy and socialism, well, I think it depends on what you mean by liberal democracy. So I am not someone, I think it's worth pointing out that, to my knowledge, at no time in history ever has any party or political force closed a representative or democratic assembly and then reopened it. So I am not someone who's in favor of shutting down liberal democracy as part of a socialist transition. I am somebody who sees socialism as the project of extending and deepening the existing democratic freedoms and rights that we enjoy to the economy, and in a more deep political way too, so that rather than just passively going to the polls every couple of years, people are brought into the political process in radical new ways to become what they call in Latin America protagonists, right, in the political process, actively shaping political programs and agendas and their social lives, rather than just kind of electing the other guys who take care of it for them. But we could talk more about that as well. In terms of ETFs in Canada, so I'm not an expert on Canada. I don't have data or anything like that in front of me, but I can definitely say that, you know, Canadian pension funds are huge investors in American ETFs, big time. And there's a really good report that the Commonwealth Fund, or no, not called the Commonwealth Fund, that's the one here. It's Commonwealth, it's just called, in the UK, Benjamin Braun and Adrian Buehler, who are actually the people I'm kind of criticizing when I'm talking about the Social Democrats. But they did a really good report for Commonwealth showing the extension of American asset management firms into the UK. And they own now a massive amount of the UK economy. And so the research on this is kind of just beginning to be done in terms of the geographies and unevenness of it. And I haven't specifically looked at the case of Canada, but I can definitely tell you that it's big. It's very big. In terms of Donald's question about central bank independence, so even in the case of the US, the independence of the Federal Reserve goes back to the 1950s, at least. You could argue it goes back before then. But what happened after 1979 wasn't just that the Federal Reserve became more independent, it was that it became more powerful, although it also became more independent. So that independence was deepened and made more radical and more insular, and its separation from representative democratic oversight was increased. But that was already a political project that actually went back to the Great Society before, of, you know, central bankers and policy elites trying to figure out, how are we going to stop the continual extension of the welfare state? We have to subject fiscal policy in a new way to market discipline, which basically meant finding ways to channel market disciplines inside the structure of the state to put a brake on on fiscal policy. That is to say, in more regular words, to separate control of the economy from democratic institutions and concentrate it in unelected, unaccountable authoritarian bodies, like the central bank. So that is a project that goes back to the New Deal in the US as a way of trying to limit the extension of the welfare state and control state spending or limit state spending and remove it from democratic input. So yeah, but in the case of Europe, I mean, it's of course also been intensified through the Europeanization project, right? The ECB, it's very noticeable in the case of the UK, where there was a very conscious and explicit move of basically shifting economic policy by a Labour government to the Bank of England and saying we're no longer going to even have a party program that deals with this anymore. Realistically, it's now going to be totally entrusted to the Treasury. So, you know, one can go on about these things. But yes, it has deeper roots. I would agree with that.
Let's see if we can take two more questions. David, yeah.
I appreciate that your argument is one of with this concentration, there's also a lot of diversification in the control, but I guess in the spirit of contradictions and exploring contradictions, I wonder if there's also a sort of vulnerability with so much power and control being held in such a small number of companies.
Yeah, I had a question about ETFs and passive investment. So, like after 2019, when we saw the emergence of semi-transparent ETFs, there's been a partial regrowth of active investment trends. And I'm just wondering if you think that's part of a longer-term trend, or if it's just a temporary phenomenon.
Good question, Mark. Yeah, so I'll first take Jane's question. Yeah, this question about vulnerability. So there is an argument that has come out from some of the social democratic analysts of this, which argues that now that we have such extreme concentration and centralization, and indeed diversification, unprecedented diversification as well, that we have the kind of personalization of the economy in the person of, say, Larry Fink, in a way that makes these relationships easier to politicize, because we can now point to the guy that's the guy doing it all, right? And we can say it's Larry Fink. You can identify him as an individual, and so therefore that makes the system vulnerable and makes it easier to politicize these relationships. Well, I think there's an element of truth to that. I think one has to be very, very careful, because the big danger would be to lose sight of the fact that Larry Fink is not subjectively in control of this. This is capitalism. So we have to, especially as left intellectuals, we have to educate people that this is about the dynamics, structural dynamics of capitalism and competitiveness, right? And the structural imperatives to accumulate and to compete. And it's not about Larry Fink, deviously Mr. Burnsing it like, in his office somewhere. I think that can have a certain value in some ways, but I think it's very open to miseducating people and misleading people about what's really going on here, which is why I try to emphasize the importance of the deeper plumbing of the financial system. In terms of Alex's question, yes, I think as market volatility increases, you would expect that active management strategies would be able to find a competitive niche at the very least. So you would expect, so hedge funds have been the biggest ones whining about QE because they depend, of course, on volatility and risk. And if there's no risk in the market, hedge funds have a very hard time making money or convincing people they should invest with them. But I think that the holdings that those active funds, and of course, by the way, BlackRock, State Street, Vanguard, all manage active funds as well, and they make a disproportionate amount of their income from those funds. But the holdings that hedge funds and so on are able to amass are nothing compared to what the big asset managers possess. And moreover, active investment strategies can actually serve to reinforce the power of the big asset management companies, because if the big asset managers who own 20% stakes in your company can make the claim that, if you don't do what we want, we're going to vote with those guys who are pursuing active, aggressive, activist shareholder campaigns, management's going to listen, right? So in other words, actively managed funds, aggressive activist shareholder strategies like hedge funds can play a role in reinforcing the power of the big asset management companies, because all that's standing between management and the rabid activists are the 20% voting bloc of the passive management funds. And if they vote yes on a shareholder proposal put forward by an activist investor, those managers are going down. So that can actually serve to reinforce the power of the big asset management companies.
Well, it's 4:20, it's getting dark outside. I think we probably need to bring this to a close. Let's have another round of applause for. Thank you all so much for being here, and so